Bank comparison. The Big Four U.S. banks, Bank of America, Citigroup, J.P. Morgan Chase and Wells Fargo and Company, reported their second quarter earnings recently. Each reported growth in revenue and earnings, but how did they stack up against each other? We put together this simple comparison analysis of the quartet to see who's performing better or has some hidden value. Shares outstanding at the banks had quite a bit of variability, with Bank of America by far having the most outstanding at over 8 billion shares. More than 400% of Citi. The higher number of shares may present valuations that seem lower than their peers. A quick look at some of the data we used. Revenue. It's clear that J.P. Morgan is the biggest bank on the street, with the other three banks reporting relatively similar turnover. Net income, not surprisingly, saw J.P. Morgan lead the pack. But there was some more variance in the bottom line results, with Citigroup trailing its peers. J.P. Morgan lead with equity, but Bank of America was a strong second despite half the net income and less revenue. Liabilities at the banks saw J.P. Morgan once again in the lead, but with big earnings come big responsibilities. Wells Fargo held the least liabilities on its balance sheet. J.P. Morgan holds the most deposits and Citigroup the least. Assets was again led by J.P. Morgan, and Wells Fargo brought up the rear. Book value per share starts to show some interesting divergence, with Citi and J.P. Morgan leading. Does Bank of America have too many shares outstanding then? Tangible book value shows Citigroup with the highest number at 85.3, though with the lowest revenue of the group. More on that in the valuations. Non-interest expenses tells us how much overhead the company need to operate their respective businesses. J.P. Morgan with the most revenue should have the most overhead. Now to the valuations. Price earnings was annualized using the current quarter earnings. Wells Fargo has the highest PE and J.P. Morgan the lowest. The average among the banks was 8.82. Earnings per share was again annualized with current quarter data. J.P. Morgan came in at a solid $4.75 per share, leaving their competitors in the dust. The average is skewed to $2.05 from the J.P. Morgan earnings, and median might be more meaningful. Bank of America had the lowest EPS, but as we said earlier, they have the most shares outstanding. Price to book value suggests that Citigroup might be the best value at only 0.48. The average and median both came in at 1.03. J.P. Morgan at 1.59 suggests they might be overvalued despite having the lowest PE. Price to tangible book value excludes the intangible assets like goodwill and tells a similar tale as price to book value. Citi may be undervalued and J.P. Morgan overvalued. Return on equity shows J.P. Morgan as the standout at 20%. With the Wells Fargo and Bank of America closer to the median price, perhaps this quarter's net income was exceptionally high for J.P. Morgan and exceptionally low for Citi due to some extraordinary charges or income. The loan-to-asset ratio is a liquidity measure showing how many assets on the books are loans. The average shows 0.36 or the median at 0.34. Wells Fargo at 0.50 suggests that they might have less liquidity than the other banks, though still not excessive. The loans-to-deposits ratio shows an industry average of 0.57 and a median of 0.55. Wells Fargo is the standout. They have more loans on the books than per unit of deposit than their peers. Deposits to liabilities indicates if the bank has access to lower-cost capital. Wells Fargo is above the average at 0.80, suggesting that they are in good shape if the need for capital arises. The industry average is 0.68, put the other banks in line with this metric. Lastly, the efficiency ratio. This shows how management is using resources like technology and people to generate income. At an average of 0.6, J.P. Morgan seems the most efficient at running their business.